A car payment can look completely reasonable on paper. $500 a month, $600, maybe $700. But here's what that number never tells you. The payment isn't the price of the car. It's just the price of keeping the loan alive. Insurance, interest, maintenance, fuel, none of that shows up in the number you agreed to. And that's exactly how an affordable car quietly becomes one of the biggest financial commitments in your entire month. Here's the strange part. Most people don't actually shop for a car. They shop for a payment. What can I afford per month is a completely different question from what does this car actually cost me? And dealerships know this. The entire financing conversation is built around adjusting the monthly number until it feels comfortable, not around showing you the full financial picture. That's not necessarily dishonest, but it does mean the number you focus on isn't the number that matters most. There's a reason this works on almost everyone, not just people who are bad with money. Our brains are wired to evaluate affordability in the short term. A $600 payment feels measurable against a paycheck. A $38,000 total cost spread across interest, fees, and years doesn't feel like anything. It's too abstract to react to emotionally. So when a payment fits comfortably into a monthly budget, it feels like a safe decision. The size of the total commitment behind that payment simply doesn't register the same way. This is the same psychological shortcut that makes subscriptions easy to ignore, or a mortgage feel smaller than it is. Break a large number into small recurring pieces, and the brain stops treating it as one big decision. But there's another reason this shortcut is so easy to fall into, and it has nothing to do with willpower. Let's actually break down what a car costs beyond the payment. There's the loan itself, principal and interest. There's insurance, which for a newer or financed vehicle is often required to be
more comprehensive and therefore more expensive. There's routine maintenance, oil changes, tires, brakes, which increases as the car ages. There's fuel, registration, and often costs that only show up occasionally, a repair, an inspection fee, a depreciation hit if you need to sell early. None of these show up in the number you agreed to at the dealership. They show up gradually, spread across the months and years you own the car. Here's a simple hypothetical illustration. Say a car payment is $550 a month. Add roughly $150 a month in insurance, $100 a month in averaged maintenance and fuel costs, and the real monthly cost of that vehicle isn't $550, it's closer to $800. That's not a hidden fee, it's just math that never gets shown to you in one place. Here's where the math gets more interesting. Auto loans used to typically run 36 to 60 months. Today, it's increasingly common to see 72 and even 84-month terms. Why? Because stretching the loan out lowers the monthly payment, which makes an otherwise expensive car look affordable. But here's what most people miss. A longer loan doesn't just spread out the payments, it also spreads out the interest. The longer you're borrowing, the more total interest accumulates, even if the rate stays the same. There's a second problem hiding inside a longer loan, too. Cars lose value the moment you drive them off the lot, and they keep losing value every year after. With a long enough loan, it's entirely possible to owe more on the car than it's actually worth for a significant stretch of the loan, a position often called being underwater. If something changes, the car is totaled or you need to sell, that gap becomes a real immediate problem. That's when the payment stops looking harmless. The loan and its interest are only part of the equation. Insurance, maintenance, and fuel don't stay fixed either. Insurance premiums shift with your driving record, your location, and the vehicle itself. Newer, more
expensive cars generally cost more to insure. Maintenance costs tend to rise as a car ages past its warranty period. And none of these costs are optional in the way a subscription might be. You can cancel a streaming service. You can't skip your car insurance and still legally drive. This is what makes vehicle costs different from most recurring expenses. They're not just automatic. They're largely unavoidable if you want to keep the car running and legal to drive. That removes a layer of flexibility that other expenses in your budget might have. Here's the trap in its simplest form. A lender or dealer can almost always find a payment that fits your budget, not because the car became cheaper, but because the loan can be restructured. Longer term, different down payment, different vehicle trim. The number moves until it feels comfortable. But comfortable payment and affordable car aren't the same thing. A payment can be comfortable and still represent a financial commitment that, once you include insurance, interest, and maintenance, consumes a much larger share of your income than you realized. This is worth sitting with, especially now. Auto lending has been climbing. According to the Federal Reserve Bank of New York's Q2 2026 household debt data, Americans took out roughly $211 billion in new auto loans that quarter, the highest quarterly total the New York Fed has recorded. Researchers noted that record reflects rising vehicle prices, more than a purely inflation-adjusted increase in borrowing, and serious auto loan delinquencies climbed to their highest level in around 15 years during the same period. That doesn't mean most car owners are in trouble. Most aren't. But it does mean more households than usual are financing vehicles right up against or past what's comfortable, and a growing share are starting to fall behind. So how do you actually evaluate whether a car is financially reasonable, beyond just the monthly payment? A few
questions help. What's the total cost, not just the payment? Multiply the monthly payment by the loan length, then add estimated insurance, maintenance, and fuel across that same period. What percentage of take-home income does the full cost represent? Not just the loan payment, but everything attached to owning the car. What happens if your situation changes? A job loss, a move, an unexpected expense. Does the car payment still fit, or does it become the thing that breaks the budget? What's the loan term relative to how long you'll actually keep the car? A shorter loan, even with a higher payment, often means less total interest and less time spent owing more than the car is worth. None of these questions require complicated math. They just require looking past the one number the entire sales conversation is built around. A car payment was never really the full price of the car. It was only ever the price of keeping the loan alive. The real cost shows up everywhere the payment doesn't, in the interest, the insurance, the maintenance, and the years it takes to actually own what you're driving. If you only ever look at what fits your budget this month, you may never notice what it's costing you over the life